Billions of dollars are flowing into artificial intelligence startups right now, but something strange is happening behind the headlines. Many of these companies are burning through cash faster than they are making it, and nobody seems to care yet. Today I want to walk you through the AI startup bubble, because understanding this matters for your career and your wallet. We are going to look at the funding hype, the GPU cost trap, the churn problem nobody talks about, and what consolidation actually looks like. This is not about being pessimistic about AI, it is about seeing the business reality clearly. Let's start with the money because that is where the story begins. In 2023 alone, AI startups raised over $50 billion in venture capital funding. That number is larger than the GDP of many small countries, and it keeps growing. Investors are desperate to find the next Google or Amazon, and AI looks like the obvious answer. When OpenAI signed a $13 billion deal with Microsoft, it set off a funding frenzy across Silicon Valley. Suddenly every startup with an AI demo and a pitch deck could command valuations in the hundreds of millions. Anthropic raised billions, Mistral raised hundreds of millions, and dozens of smaller companies hit unicorn status overnight. The narrative was simple and seductive: AI is the next platform shift and early winners will own the future. But here is what that narrative conveniently ignores: most of these companies have no clear path to profitability. They are burning cash to acquire users, build models, and rent computing power from companies like Nvidia. The strategy only works if capital stays cheap and investors stay optimistic, and both of those assumptions are now cracking. That brings us to the second piece of the puzzle, the GPU cost trap that is strangling AI startups from the inside. Training a large language model requires thousands of Nvidia H100 GPUs, and each one costs around $30,000. A competitive AI company needs hundreds of these chips just to stay in the game, and that is before you count operational costs. Electricity to run these data centers can cost millions of dollars per month for a single training run. The result is a business model where the infrastructure costs are fixed and enormous, while revenue is uncertain and slow to arrive. Nvidia has become the unexpected oil barons of this gold rush, selling picks and shovels at premium prices. Their data center revenue grew from $3.8 billion to $22.6 billion in just 2 years. Meanwhile, the startups buying those GPUs are paying rents that would make any traditional business wince. The cruel irony is that many of these companies are building on rented infrastructure they will never own. They are burning capital to train models that will need to be retrained again in a year when the next breakthrough arrives. This creates a treadmill where startups must keep spending just to stay competitive, and that is before we look at the customer side. The third piece of the puzzle is the churn problem that nobody in the industry wants to discuss openly. AI products face a brutal retention challenge because most of them lack true switching costs or deep integration. When a user can copy their data and try a competitor's model in an afternoon, loyalty becomes almost impossible to build. Many AI startups report monthly churn rates that would terrify any traditional SaaS investor. Users treat these tools as novelties, trying them for a month and then moving on when something shinier appears. The customer acquisition cost often exceeds the lifetime value by a factor that makes the unit economics mathematically broken. If a startup spends $50 to acquire a user who generates $10 in monthly revenue, they need 5 months just to break even. But if that user leaves after 3 months, the company has lost $40 on every customer they brought in. Multiply that across thousands or millions of users and you have a business model that only works if you keep raising capital. The venture capital model was designed to fund growth over profitability, but that only works when optimism is high and capital is cheap. When the music stops, when investors start demanding real revenue and real margins, the whole house of cards gets shaky. We are already seeing the early signs of this shift in the market right now. Major venture firms like Sequoia and Andreessen Horowitz have started asking different questions in pitch meetings. They want to see revenue, they want to see unit economics, and they want to know when the company becomes self-sustaining. For many AI startups that raised during the boom, this is a terrifying conversation because they do not have good answers. They expanded teams, signed long-term GPU contracts, and built infrastructure assuming the funding would keep flowing. Now they are stuck with fixed costs and no clear path to profitability, and the next funding round looks much harder to close. This is where consolidation enters the picture, and it is happening faster than most people realize. Larger companies are already circling struggling AI startups like vultures circling wounded prey. Microsoft, Google, and Amazon are quietly acquiring AI capabilities to fill gaps in their own ecosystems. Salesforce, HubSpot, and other enterprise software companies are buying AI startups to bolt onto their existing platforms. The logic is simple: it is cheaper to buy a working AI product than to build one from scratch, especially when startups are desperate to sell. This creates a brutal environment for independent AI startups that cannot find profitability on their own. They either get acquired, often at a fraction of their last valuation, or they run out of money and shut down. The ones that survive will be either extremely well capitalized or already generating real revenue from real customers. Everyone else will become a cautionary tale or a footnote in someone else's acquisition announcement. Now I want to be clear about something because the bubble narrative can be misleading. Not every AI startup is doomed, and the technology itself is genuinely transformative and here to stay. The bubble is not about AI being fake, it is about how we allocated capital during the hype cycle. What we are witnessing is a necessary correction that will separate real businesses from companies that were only built on investor money. For you as a viewer, this is actually useful information because it changes how you should evaluate AI tools and AI companies. Instead of asking, does this use AI, ask, does this solve a real problem that people will pay for consistently? Look for products with high switching costs, deep integrations, and customers who would be inconvenienced to leave. Those are the companies that will survive the consolidation and potentially become the next generation of tech giants. The ones that will not survive are the ones that raised too much, spent too fast, and never built anything people actually needed. So what should you take away from all of this if you are a student, job seeker, creator, or small business owner? First, do not be impressed by valuations or funding numbers, those are often signs of excess rather than success. Second, pay attention to which AI tools people actually use and keep using, that is a much stronger signal than headlines. Third, understand that the AI industry is going through a shakeout that will take 2 to 3 years to fully play out. Many of the companies you see today will not exist in their current form by 2027, that is not a prediction, it is a pattern. The same thing happened during the dot-com boom. The internet was real but dozens of companies still went to zero. The key is to watch the business models, not just the technology demos, because technology without a sustainable business is just a science project. If you found this breakdown useful, subscribe for more videos on business stories and hidden money systems. I will be covering more AI industry analysis, startup economics, and the patterns that separate winners from casualties. Until next time, stay curious and always look beneath the hype.